Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of corporate filings. Today we're cracking open Upbound Group's latest report. It's a bit of a mixed bag, some good news, some not so good, and a shiny new acquisition that might just change everything. We will explain it all in simple English because who needs more confusing financial jargon? Upbound Group, they are in the lease-to-own business. If you need furniture, electronics or appliances but can't pay up front, they offer a way to get it now and pay it off over time. It's like renting but with the option to eventually own. They also just got into the financial health space with their latest purchase. This report covers Upbound's performance through March of this year. Let's dive in and see what's been happening. Time to see how much money this company makes and loses. Let's scroll straight to the financial statements. We'll check the summary, starting with a quick look at the condensed consolidated statements of operations, or as normal people say, the income statement. The company's revenues from rentals and fees, that's where most of their money comes from, and it shows 890 comes from, and it shows 80.99 million. It went up compared to last year. They also make money from merchandise sales, which is at 2036 million. This comes from people who choose to buy the items they're renting instead of just renting them, a good option to have. After taking all costs into account, Upbound's net earnings or profit, it's around 24.8 million, which sounds great, but it's actually down from last year. Last year, it was at 27 million. The company had a comprehensive income of 24.7 million compared to around 28.3 million the prior year. Let's talk about the balance sheet where we can measure the net worth of the company. Balance sheets are like a financial snapshot telling us what a company owns, which are assets, and what it owes, which are liabilities. This tells us the financial health of the business. The company had a total of 107 million in cash, which is great. It increased a lot compared to the end of last year. A very important metric to look at is also what the company has as debt, or what they owe. Turns out Upbound owes a lot of money. This can be worrying to investors. They owe 1.09 billion in what they call senior debt. This also increased from last year. This is a key risk with these types of businesses, and 402 million in senior notes, whatever that means. And finally, there is stockholders' equity. It went up to 679 million from 628 million. Stockholders' equity is the money that would be left if a company sold all of its assets and paid off all of its liabilities. Now let's check the cash flow statement, which tracks the movement of cash both into and out of the company. If the balance sheet tells a company's health, cash flow statement is how healthy it is over time, if it has cash coming in or going out. It starts with the net earnings we mentioned earlier, the total revenues minus total costs. Then it adjusts for things like depreciation of their rental merchandise, depreciation being the expense of something wearing down over time. And then the company ends up with 137 million of net cash provided by operating activities, meaning the day-to-day business is bringing in a good amount of money. However, it got spent real fast, with the company having negative 280 Bs, acquisitions being the main culprit. That Brigit purchase was not cheap. So it gets offset by some cash from financial activities, which can include borrowing money, which ends up with the 107 million we mentioned at the beginning of the cash section. Let's move to the notes on the financial statements. I know, sounds boring, but this is where companies have to be upfront, and they explain things that are not that obvious in their financial tables. The company has 4 operating segments: Asima, Rent-A-Center, Brigit, and Mexico. After the recent acquisition of Brigit, the company added it as a new operating segment. Speaking about Brigit, let's take a look at the acquisition and what the company thinks that the company is worth. The deal closed for nearly $400 million, about 2079 million in cash and the rest in stock. With cash used in the transaction above and other assets, Brigit is being added to the balance sheet for a net amount of 392 million. It remains to be seen if the business lives up to its evaluation, or it gets written down if they find it to be worth less at a later date. There are even more payments coming in the future. Most of the intangible assets are customer contracts at 144 million, as those paying customers are worth quite a bit. So the company is very excited about the purchase, estimating or projecting a large amount of additional revenue for the next year because of the purchase. The numbers are nice, and it remains to be seen if they will be true, but keep in mind this is based on company supplied information. Let's find out where all the money is actually coming from. Their revenue depends on a few things, which can include car rentals and fees, payments for use of goods. merchandise sales, payments for customers to own those goods, subscription and fees. In the Brigit segment, they also receive payment from subscription models. Money that is due to the company comes from a few different places. Cash advances that are to be paid at a later date from the Brigit acquisition, as to installment sales, that are expected to be received later from the retail installment stores. Camtrade and notes receivables include accrued revenue related to the company's lease-to-own agreements. Accrued revenue is revenue that has been earned but not yet collected in cash. It goes without saying that this is a big risk because, as the scroll below mentions, this has a big allowance for doubtful accounts, meaning they know it won't get paid, it's in the next row. Let's take a look at allowance for doubtful accounts, also known as uncollectible accounts. The company thinks it won't be able to collect on 21 million. For a business that needs cash to stay afloat, not collecting on what it is owed is one of the biggest risks. The company owes a ton of money. That's why there is some chatter about their debt, but here we see an actual listing of their debt and how much has to be paid in each period. It seems very manageable, although high, because it's only when 2028 comes that they have to pay a huge sum. And a senior debt, because in case of bankruptcy or problems, debt is senior, in that it's paid before other debts, so it's higher priority and safer for the lenders. Fair value estimates is also something that should be monitored. Lots of accounting details that the company has to mention, but scroll to what is most interesting. This operating segment makes 489 million in revenue, but the company owns 637 million and 31 million and 18 million in the other operating segments. Then in early December 2021, our board of directors authorized a stock repurchase program for up to $500 million, meaning the company can use its money to purchase shares and make the stock price go up if they think it's worth doing so. Companies do this to signal to investors that they think the company is worth more, or to drive up the prices and get rid of shares. It's a tactic. Okay, we get to legal issues. This is important. There was a lawsuit from the Consumer Financial Protection Bureau. This is not good for the company, but Usima won the case after the case was dropped. It could have gotten very costly to pay the fines and damages that the case was pushing for. Now, there is still some stuff left. The multi-state investigation and the New York Attorney General lawsuit that is still in play, but the company thinks it will win. We will see. Alright, this part is pretty standard earnings per share information. Let's skip to the end secti now that we've covered the details. What's the real story here? Upbound is in a period of change. The numbers show a company navigating mixed economic signals, balancing growth with debt. The big move is definitely the Brigit acquisition. Upbound is betting big on financial technology. A great opportunity, but a big risk, because if Brigit does not work, they might have to write it down, meaning the purchase was worth less than expected. This can also affect the stock price if that happens. The core lease-to-own business, Rent-A-Center, appears to be struggling. Declining revenue and same-store sales need to be addressed urgently. The business is going down and not up. And Niacinamide growth is definitely the diamond in the rough, because it shows what happens when the company pivots to take advantage of market opportunities and consumer trends. In conclusion, Upbound Group is at a crossroads. They are either going to be a success and have their acquisitions grow bigger, or they will stay as they are and face new lawsuits, government actions and debt, while their growth isn't looking great. This is why it should be monitored closely. That's all for today, folks. If you found this breakdown useful, don't forget to like, subscribe, and hit that's all for today, folks. If you found this breakdown useful, don't forget to like, subscribe, and hit that notification bell to stay updated. And I will see you on the next one.